Okay, so I'm going to merge AS and A2 ratios together, and let's see how much we can do. Okay, in today's class. So starting off, this is your chapter 34. Analysis of published accounts. So in your AS syllabus, you will be tested on these two ratios specifically. Okay, that is liquidity ratios. Do you know what liquidity means? Nope.
No, my son.
Okay. And profitability ratios. Liquidity, in simple words, means firm's ability to pay off what they've borrowed, okay, of their liabilities. So this kind of tells liquidity ratio, they tell us how much the business, it measures, basically liquidity ratios measure how a business can meet its short-term debts or liabilities, basically. Okay, so it kind of tells you how much of the waters are you in, gives you a real picture of how much you owe, how much you own, and all that. Okay, so liquidity ratios are important to measure the ability of businesses for them to be able to continue trading. Otherwise, if they're in debt, they'll be too much in debt, and making profit will be pretty much useless for them, right?
Yeah.
They're concerned with the working capital of the business. So if there is too little working capital, then the business would become illiquid. Illiquid means failure to pay off their loans or their borrowing. And if you, yes, it's illiquid.
Okay.
Okay. So this is you failing to pay off your borrowing. And if you are an illiquid business, a business that cannot or fails to pay off their loans or the money or something that they've borrowed, then they will kind of, your suppliers, investors, nobody would want to work with you. Okay.
Okay.
So the very first ratio that comes in liquidity ratio is your current ratio. Okay. Your current ratio tells you basic generic, the major formula to calculate current ratio is simple. Your current assets, the things that you own, okay, divided by your current liability. Okay, so how much you own and how much you owe, okay? Whatever you owe divided by how much you owe, okay? Things to keep in mind is that the result will always be in a ratio. Okay, so let's say my result here is 2/1. That makes it, in a ratio form, this is 2:1. That is my ratio. Okay, what is this telling me? This is my asset. This is my liability. Okay, this shows that my business at this point can pay off my whatever I've borrowed. So this two is what I own, and one is how much I owe. That means I don't owe much, as in I own double of what I actually owe. So let's say I own $200, but I owe $100. That is clearly telling me that yes, I can pay off my debts, short-term debts, right? So
Yeah.
2:1 is a good ratio. However, if it was the other way around, 1:2, then that would have been a little bit of a problem here. Okay? Then you would have been in a bit of trouble. Okay?
Yeah.
Clear?
Yeah.
So let's give you a quick question. Let's say, can I take a screenshot of this? 1 second. Let me give you a quick question on this. You can practice it as we go along. Let me make a document for ratio practice. And I can assemble all the ratios over there for you for practice. Ratios practice sheet. I'll give you access to it. You have a choice. Either you want to do it on paper, that's fine. You want to do it on the computer, I'm okay with that. Okay. I've just given you access to this.
Okay.
Check your mail. Yeah.
You sent it to me by email?
Yes, check your mail. I've shared a Google document with you.
Okay, let's open it.
Okay. Have a look at this. See if you can calculate. So how would you calculate this as a question? If this was a question in your test, there is 1 mark for just writing the formula. Okay.
Yeah.
So you would simply, so if the question is asking you to calculate the current ratio, oh, they've already calculated for you. Okay.
Yeah.
Imagine, okay, 1 second, there you go. I've made it disappear. Now you can't see it. Now calculate the current ratio.
Okay, it's just the current assets over the current liability. So
yes. So your step one would be, so we learned 3 things over here. One, that 1 mark is just for the formula. So your step 1 would be writing the formula. You would write current ratio is equals to current assets divided by current liabilities.
Yeah.
That is already given you 1 mark. Then your second step would be for PLS, it's, what is it?
100 over 50, which
100
is
over 50, which is
1 over 2.
Mm-hmm.
Yeah, 1 over 2. So then it's
1:2.
Yeah, oh yeah.
Yes.
I don't know.
Yes.
Okay.
Okay. All right. And then let's say they were asking you to comment on whatever because let's say you've got your 2 marks now. This is your paper 2 style question, by the way. So for 2 marks, you've done the calculation. For 3, and then they're asking you, there's always going to be 2 parts to this kind of a question. There'll be part A, which is this, and there'll be part B. This would be 2 marks, and your part B would be 3 marks. Okay. Current ratio. Now they're asking you to comment on their ability to pay off their whatever they've borrowed, or their liquidity. Okay, so what you're gonna say that PLS has a current ratio of 1
Miss,
is to
it's
2.
I think it's
Yes.
2-1, by the way.
Okay. I
It's
need
all
my calculator. I trusted you. Okay. 100 divided by 50.
it's 2.
This is
So
2/1.
2/1, yeah.
2:1 is equals to 2:1. The tables have turned. Suddenly they're all stable.
Mm.
2:1. Now you're going to comment which highlights PLS has double the assets as compared to their liabilities, which means
Miss, when am I supposed to, like, what would the question be for letter B?
comment on the results from A.
Oh,
Could be as simple as that. Okay. So there, PLS has a current ratio of 2:1, which highlights PLS has doubled the assets as compared to their liabilities, which means the business can pay off the debts easily or blah, blah, blah. Okay. This is your complete answer. Okay. Got it?
yeah, but can you give me just 1 second so I can write it down?
Sure. Then you're going to do BSK yourself.
Okay. Okay, miss. Done.
Okay.
I
Got the
did.
second answer?
Yeah.
Mm-hmm.
I wrote that like because their what's it called? Their assets and their liabilities are equal, right?
Okay. Let's see.
Yes.
Let's have a look. Yes. Yes.
So that
What do
means
you
they can
think? Yeah.
pay it off the debt, right?
Yes. They can pay off their debts, but do you think that's a good thing? That I've borrowed $100 from you and I only have $100, and you're like, hey, give me my $100 back. And I'm like, okay, take it. And now I've got nothing to run my business. Is that a good
Yeah.
thing?
No, it's not.
No, it's not. So that's what you need to talk about in your comment. You get it?
Okay. Yeah.
Yeah. Quickly write that down. Just working on your commenting as well. These are those parts where you can just get marks for free.
Miss, how am I supposed to write that part down?
Okay.
I wrote
This
so far.
highlights. Yes. What have you written?
I wrote BSK has a current ratio of 1 to 1, which shows that BSK have equal assets and liabilities, which means the business can pay off the debt. However, and then
However, or although this shows that although they can pay off their, although this does not make the business illiquid, but this is not a great position that BSK wants to be in,
okay.
as they would want more, assets than what they owe. Search, image, download. Done?
Yeah.
Okay. Moving on to the next type. I've just added this on the document so you can keep it for record. Moving on to the next type of ratio. Okay, so just few things. I'll also add some points over here. Now look at this. There were some points or sample comments that I'm adding over here that you could use for your next time on the same document. So points to note, PLS is in a more liquid position than BSK. So by the way, in your exam, you can also get a comparison on not necessarily of two separate businesses, but you can get a comparison of businesses, a business from previous year to this year, or comparison of uh, their liquidity over a period of time. So here we're working on how to kind of comment on these businesses and making a comparison. PLS is in a more liquid position than BSK. PLS has twice as many current assets as current liabilities. For every $1 of short-term debts, it has $2 of current assets to pay for them. This is a relatively safe liquidity position. This is how you comment. Do you see it? Now that you've seen a sample, you have a better idea. Got it?
Yeah. Yeah, got it.
Then look at this. The current ratio of BSK is more varying. It only has $1 of current assets to pay off for each $1 of short-term debt. In the unlikely event that all of the short-term creditors demanded repayment at the same time, imagine you ask all of your people you've borrowed from, they ask you to pay off your debts. What are you going to do? You're going to be stuck, right? Because you don't have enough to pay for them. To them, it would be struggle to pay them all. This would be even more of a problem if some of the current assets could not be converted to cash quickly. What are current assets, by the way? Things that you own, right?
Yeah.
Can you name some types of current assets a business could have?
Uh, Miss, it could be anything, no?
Yes, like what?
I don't know, like, let's say, like, maybe, like, one of the shareholders could sell, like, a house or something.
A business would have a house, okay. um Current assets are things that a business could own. What are the things a business would own? Think about that. What are the things a business could own? Machinery? Yeah.
Oh, yeah.
Their land, right?
Yeah.
Inventory,
Mm.
right? So these are types of your current assets. Okay. However, if you look at this, like it says in our comment of this would be even more of a problem if you look back on the document, I just highlighted that term. This would be even more of a problem if some of its current assets could not be converted into cash easily. Which asset over here cannot be converted to cash easily?
Machinery?
You can't sell machinery?
You can.
Yes.
Oh,
So
you can sell land, maybe
yes,
inventory.
inventory. Why do you think that is? Why do you think inventory? Because it doesn't
Because,
get,
like,
you've got stock. Okay, yes, yes, yes.
no, it's fine. Continue.
Okay, you've got stock, you've got inventory. You're not sure if it's gonna sell off. It's just there in your stock room or your, warehouse. You're not sure if the customers are going to buy, and you're not sure how long they're gonna take to buy it. You're not sure of how long it will take for them to purchase that, right? And for that inventory to turn into money, right? For instance, I owe you money, but I have a fish business. You're like, you borrowed $100 from me, so I want you to give me my $100 back. I would say I don't have $100 right now, but why don't you take some fish worth $100? Would you take it? No, right? I'm a
Yeah.
fish business. I wouldn't give you fish. You wouldn't accept fish. So inventory is the least liquid asset. You need to remember that. Inventory is your least liquid asset. And that is what they were saying in the comment there. Okay, and that brings us to our next ratio, which overcomes the barrier of of a current ratio. And this is called an acid test ratio. Your acid test ratio basically takes off your, basically the formula is current, okay, 1 second, current assets divided by inventory, sorry, divided by current liability. And to give you a clearer picture and the prospective occurrence ratio, acid test ratio, is that inventory is the least liquid asset. So we are excluding inventory from assets, and we're going to get our acid test ratio, and that is what's going to give you a clearer picture. So acid test ratio, the actual formula is actually liquid assets divided by current liabilities. So basically your liquid assets are all of your assets minus inventory. So the formula to get your liquid asset is current assets minus inventory. In fact, it won't even make a difference. It won't even matter if you don't learn this formula. Okay, it's not important. This is something that you should remember when it comes to this. Current assets minus inventory divided by current liabilities. Here you are completely eliminating inventory, and you're saying that um, we don't believe that inventory, like I give you the fish example, right? So your inventory doesn't count as an asset, and henceforth your asset test ratio will give you a better and a clearer picture. Okay, cool, got it?
Yeah.
Yes. Now look at this. I'm giving you results of PLS and BSK's asset test ratio. I want you to comment on that. Okay, so I want you to compare, or just give me one single comment on each of these ratios. Going back to the document. Okay, go back to the document. I've just added a table over there for asset test ratio. Asset test. Now you can use the words from above and maybe work on commenting the ones below it.
Miss, so you want me to do the same thing?
Yes, but I want you to comment on the asset test ratio basically.
Okay. Miss, so BSK here is illiquid.
Okay, let me see. 0 is to 75 is to 1. Yes.
So
Yep.
they're illiquid. Okay.
Mm-hmm.
Okay, Thomas.
Okay, perfect. What did you write? Let me see.
Uh, I wrote
Mm-hmm.
PLS is in a more
Yeah.
liquid position than BSK. PLS has equal assets and liabilities, therefore PSL may struggle to pay off all their liabilities but still be able to pay off debt. PSL will be in a bad position since they won't have enough assets to be converted into cash quickly. BSK is illiquid. Their current ratio is 0.75 to 1, which shows that BSK will not have enough current assets to pay off debts or liability.
Perfect. Okay. Now let me show you what I have over here. Read this real quick. So do you see how they've written as well? So it's just them doing the comparison. Results below 1:1 are often viewed with caution by accountants. Such results mean that the business has less than one. So PLS is also not in a great position when you look at the real asset test ratio. Okay, so that is also a situation. However, when you look at BSK, that is also is giving us a very bad situation here. That full picture needs to be gained by looking at previous year's results. For example, if last year BSK had an asset test of 0.5 is to 1, this means that over the past 12 months, its liquidity has actually improved. So always remember that as well, that when you're doing, because this is how they're going to give you in your paper 2 case studies, they're going to give you comparisons and you're going to have to compare results and see. Okay, so if their liquidity was 0.5 last year and now it's 0.75, that means they've actually done better, not worse. Okay,
Yeah.
so that is also one thing we are going to look at. Okay, so these are just aspects that you need to look at. Moving on to the next ratio. um Okay. How can you, by the way, what are the methods that you can adopt to improve your liquidity? Let's have a look at that first. Methods to increase okay. First aspect, one, how do you think you can improve your liquidity? First one is your sell of your
Asset.
fixed assets, yes, for cash. But what if you really need that asset and you also need the money? What do you think that what do you think you could do? So you need the machinery, but you also need money. So you sell off your machinery, but then what are you left with to work with? A solution for that? Do we have a solution for that? We do.
Oh,
Okay. We
okay.
do. Okay. You sell and lease back. If the business still needs it,
And lease what?
lease it back. So for instance, you're selling a machinery, but you can take it back on lease. Lease is when you basically pay off small amounts or installments for a certain period of time. Okay. And at the end of the lease period, the machinery won't be yours. Okay. So you can kind of upgrade and be like, now I want to lease a different machinery because the one that I've been using is now outdated. Like I've always said, always buy land and lease machinery because machinery will go out of date, so you don't really want to own it anyway. Okay. So
Uh,
so um how you could improve your liquidity is selling something that you own and take it back on lease. That way you'll get a huge amount of money coming into your inflows, and your outflow would be what your expenses would increase, that you will be paying off your lease every month or so. So that way your fixed cost would increase, but that also means that there's going to be a huge sum of money that's coming into your business, right? So
mm,
so perhaps this is your recommendation point, okay? For your, if there is a question. I'm giving you these things. Why? Because you will need these things in your exam for your commenting, okay? So in your case study, maybe you're recommending them to do this particular thing. Now, what
yeah,
can you do for, however, there's always going to be a counter argument or evaluation, right? So let's look at the evaluation aspect of this particular thing, where, have a look at this. If assets are sold quickly, they might not achieve their real value. What do you think I mean by that? You're trying to sell off your phone urgently. Do you really think you're going to get the real value? Because you're selling it so urgently and you desperately need money. For instance, a business has owes someone, so their liabilities are really high and they owe somebody something and they're asking for their money back, and the business needs money urgently. That means they're trying to sell off an asset of their own really urgently just so that they could pay off the loan or the liability. So maybe they were, because they're so desperate for money, they'll be like, fine, just sell it off for whatever's been sold off for. So you're not really getting the actual value of your asset, not the real value. Do you get it?
yeah,
Yeah. And
yeah.
then another counter argument is that if you still need the assets, so if the assets, I hope you're writing this down.
I almost.
Yeah, great. Still need it. Then leasing charges they'll add to overhead expenses. So that means your profit margin decreases because now you're paying off an overhead expense. Got it?
Um,
Okay.
and then can you
Thing,
please explain?
yeah.
Yeah,
Your
please.
second, can I what?
Can you re-explain, please?
This one? Okay. So like I said, if you still need the machinery when you're selling it off, you're leasing it back, right? So when you're leasing it back, when you're leasing something, you have to pay installments. You know what installments are? A smaller amount of the great amount that is the final payment. So let's say you sell off your machinery for $5,000. That gives you a sudden inflow in your account of $5,000. That's a good thing, right?
Yeah.
But you still need that machinery. So you are leasing it back. And to the company that you're leasing it back from is saying that you have to pay $500 every month for um, 1 year. Okay. So that means that although you had a sudden increase in your inflows, great, yes, we were able to pay off our loans, but now you have an overhead expense to pay every month. So if you were making $1,000 profit every month before, now you will only be making $500 profit. Why? Because you're giving half of that for your lease. Got it?
Okay. Yeah, I got it
So
now.
that is a drawback, right? You're paying off your overhead expenses. That's like a bad thing. It just
Yeah.
decrease your profit. Okay. Okay. Another way, another recommendation could be that we could encourage, a business could encourage you the use of JIT inventory management. Do you remember what JIT is? Just in time inventory?
No.
Just in time inventory is part of lean production. You basically order the inventory when you need it. That way you'll be
Oh,
saved from stock holding cost, warehouse cost, security cost, insurance. You just order when you need the stuff, right?
okay.
So that way you're saving a lot of money, right? So
Yeah.
one recommendation you could make over here is that to avoid and have a better asset test ratio, you just don't even need to hold any money in the inventory. Just order when you need it. Don't need to hold up your money in inventory. Okay, so that is the recommendation you're making. But then there is an evaluative point that inventory might be needed. What if there's a sudden increase in demand? Then you will be out of stock. You won't have inventory to produce. And that way you lose your customers, right?
Mm.
So this is your second aspect. Okay. There is more evaluative and recommendation points in Peter Stimson. If you go over that chapter, it's chapter 34. There's an entire table. You can have a look at that. Okay.
Okay.
And there is, if you want to practice these ratios, I can give you some questions. Do you wanna?
Yeah, sure.
So I'll just add it to that same document. There you go. I've just added one entire exercise to this document where you have to calculate the asset test ratio, current ratio, and do an analysis of the analysis of the liquidity. So you'll talk about that and then recommend in question 4, you'll have to make recommendations like I just did with you in this particular screen. And you don't have to do the last one if you want.
Miss, where is this?
It's on the next page, scroll down.
Oh, okay, just loaded.
Okay. Yeah. So this is your current ratio for now. Your liquidity ratios. Next,
Okay.
we're gonna do profitability ratios. Okay.
Okay.
All right. That's about it.
Okay, thank
You
you.
can do the homework. Yeah, you can do the homework and share it with me. We're discussing in the next class, which is on Friday. Yes.
Okay.
Okay. All right. I'll see you then. Bye bye.
Bye, Miss. Thanks.